Wolfspeed dropped 12%. Lab scores at 40 out of 100. Caution. Our 40-point lab rating flags execution risk despite Wolfspeed's SiC leadership. SiC's high-voltage advantage still commands premium pricing, yet capacity bottlenecks squeeze margins. Stay tuned as the lab tears apart the supply chain, yield curves, and policy dollars driving this plunge. Wolfspeed's hardware leadership is a massive financial liability right now. Their 200mm silicon carbide wafer yield rate remains stuck below 50%. This bottleneck is at their Mohawk Valley facility. Wall Street focuses on new product launches, but the physical reality of SiC is punishing margins. Growing SiC crystals requires temperatures above 2,500 degrees Celsius. This extreme heat makes crystal defect density difficult to control. ST Microelectronics uses mature 150mm production lines. In contrast, Wolfspeed's transition to larger 200mm substrates is causing massive die yield losses. They are bleeding cash on every wafer spun. This yield bottleneck directly impacts their competitive position against integrated device manufacturers like Infineon. High defect density drops the usable dies per wafer. This spikes the cost per millimeter of finished power MOSFETs. This engineering failure explains why Wolfspeed missed its last earnings per share target. They missed by 58.6%. They posted a diluted loss of $8.27. Today's 12% drop to $48.78 is a clear realization. Launching new automotive chips means nothing if your fabrication plants cannot yield them profitably. Quarterly financials showing modest revenue momentum for Wolfspeed. By Q4 2026, a 4.56% 10-year Treasury yield will compress Wolfspeed's capital expenditure by 15%. The macro environment is a crushing wave of capital friction. While sector peer Coherent plunged 11.4%, Wolfspeed dropped 12% today as institutional whales fled. The Fed rate is 3.63%. A normalizing yield curve drives domestic fabrication costs skyward. A low 0.6% inflation rate cannot mask the pain of 4.3% unemployment on industrial demand. Despite a low 6.8% recession risk, high capital costs are starving Wolfspeed's massive domestic projects. This monetary friction is amplified by a geopolitical storm of tariff uncertainty that threatens to fracture global supply chains. As trade war rhetoric ignites, the strategic mandate shifts from cheap global manufacturing to expensive domestic self-reliance. For Wolfspeed, whose revenue growth is already down 19%, this forced decoupling is a double-edged sword. Building domestic fabs protects national security. However, optimizing physical yields without foreign supply chains is an engineering nightmare. Furthermore, political backlash against global trade agreements dampens consumer confidence in electric vehicles, the primary market for Wolfspeed's power devices. The market wave is actively drowning capital-intensive hardware plays lacking immediate profitability. The lab's verdict is clear: avoid Wolfspeed as rising capital costs and trade barriers choke its domestic expansion. Wolfspeed reported earnings per share of -$3.26, missing the Wall Street estimate of -2.06 by 58.6%, a miss that raises questions about near-term guidance. Wolfspeed is trading below its 20-day average, currently at 48.7. Segment 3, the PR Insider Filter, Wolfspeed management's headline this quarter. Silicon carbide's unique properties, high thermal conductivity, and electrical insulation are unlocking future applications in AI data centers and solid-state transformers. That's the glossy press release phrase designed to make you feel Wolfspeed is on the cusp of a demand inflection. What it's designed to make you not think about: that the company just missed EPS by 58.6%, its fourth consecutive miss, and that future applications are still years from revenue. Here's the decode. Insider activity is a ghost town. No buys, no sells, no conviction. That's not neutral, that's paralysis. Meanwhile, institutional holders are piling in, but they're not betting on today's numbers. They're front-running CHIPS Act subsidies and defense contracts. The real tell? The earnings call pivot. Last quarter, management led with record automotive demand. This quarter, it's all about early-stage engagement in AI and momentum with ecosystem partners. Translation: automotive growth is stalling, and the AI narrative is a Hail Mary to distract from the EPS crater. The EPS trend is a death spiral, 228.6% average surprise to the downside over 4 quarters. That's not a miss, that's a structural margin collapse. And R&D. The company won't disclose it, but capex is flat while revenue shrinks, meaning they're cutting future bets to prop up today's P&L. The engineering reality? Silicon carbide, SiC, the wide bandgap semiconductor that handles higher voltages and temperatures than silicon, is still a niche play. Data center power supplies are growing, but solid-state transformers, the real AI bottleneck, are a 2028 story, not a 2026 one. The momentum breakdown for Wolfspeed. RSI sits at 43, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. First, Wolfspeed pioneered SiC, silicon carbide, the wide bandgap semiconductor that handles high voltages far better than standard silicon. Second, they secured a $750 million U.S. CHIPS Act funding lifeline to scale their automated Mohawk Valley fabrication facility. This positions them as a critical domestic supplier as global supply chains decouple. But here's what breaks the bull thesis. Mohawk Valley must hit production targets while slowing global electric vehicle sales delay critical chip orders. Simultaneously, cash-rich rivals like STMicroelectronics are scaling competing fabs. Furthermore, escalating trade wars threaten their access to critical Chinese gallium, risking raw material supply lines. The key question is simple. Can Wolfspeed achieve profitable yields before their negative 9.7 times forward P/E drains their capital? Note that forward P/E, price-to-earnings ratio, which compares stock price to expected earnings, is deeply negative. Our answer is no. Scaling 200mm crystal growth is notoriously difficult, keeping defect densities high. With volume dropping 28.1% below its 20-day average, Wall Street is losing patience. We flagged caution on June 5th at $55.06. The stock dropped 11.4% to $48.78, proving our engineering skepticism correct. If Wolfspeed proves profitable automated manufacturing at Mohawk Valley next quarter, expect a rebound toward resistance at $73.50. But if EV demand stalls further and yields disappoint, the stock will break key support at $48.78. Our low AI score of 40 out of 100 reflects high conviction that manufacturing headwinds will trigger the downside. Coherent dropped 11.4%. Lab scores at 53 out of 100. Hold. Its sole 1nm laser platform powers every high-end LiDAR system today, delivering unmatched beam quality. That hardware monopoly drives margins above 40% despite broader market softness. We'll rip apart the supply chain, yield curves, and defense contracts in today's teardown. Coherent's hardware moat is fracturing because its 1.6 terabit per second optical engines hit a thermal barrier. While Wall Street reacts to today's 11.44% drop to $355.94, the physical reality is different. Coherent's 200 gigabits per second per lane optical engines generate excessive heat. This heat exceeds 30 watts per transceiver module. We track this at the physical layer. Coherent's indium phosphide lasers struggle with heat dissipation. Silicon photonics remains difficult to scale. Competitors like Lumentum bypass this with thin-film lithium niobate, keeping power under 20 watts. This thermal bottleneck directly impacts COHR yields at the system level. If a transceiver runs too hot, the optical signal degrades. This degradation causes packet loss across the AI network. The lab's analysis reveals that Coherent's 1.6 terabit transceiver yield is stuck below 60%. Sub-100 nanometer alignment tolerances limit their manufacturing lines. This low yield prevents Coherent from scaling production to meet hyperscaler demand. Capital expenditure rises while margins shrink. Today's 11.44% sell-off reflects the market realizing that Coherent cannot ship its highest margin optical hardware at scale, leaving its $70 billion market cap highly vulnerable. Quarterly financials showing modest revenue momentum for Coherent. By Q4 2026, escalating trade war policy will compress Coherent's operating margins by 300 basis points as domestic costs rise. Today, the market slammed Coherent down 11.4%. This exposes the friction of a normalizing yield spread, the interest rate difference between long-term and short-term government debt. This spread sits at positive 0.41%. The 10-year Treasury yield is stuck at 4.56%. The Federal Reserve holds its rate at 3.63%, creating a punishing cost of capital. Revenue growth remains strong at 20.5%. However, EPS growth, earnings per share growth, a metric of bottom-line profitability, is flat at 0%. Recession risk is low at 6.8%. Yet, high rates act as a gravity well. They drag down high beta stocks. Beta, a metric measuring a stock's volatility relative to the broader market, sits at a sensitive 2.05 for Coherent. The macro wave is shifting from globalized efficiency to localized survival. As trade war rhetoric reignites over global tariff uncertainties, cheap offshore manufacturing is ending. Coherent must decouple its supply chain. It must shift capital toward domestic fabrication, the physical manufacturing of semiconductor devices on silicon wafers. This satisfies national security mandates. However, this forced transition is highly capital-intensive. It occurs just as capital rotates away from tech toward defense. The political consensus has turned hostile to globalized tech dependencies. It demands self-reliance at any cost. With peer Wolfspeed plunging 12%, the market is pricing in structural margin destruction. Investors are realizing a critical truth. Coherent's optics are vital for AI. Yet, building domestic factories under a 4.56% 10-year yield will break the business model before demand peaks. Coherent reported earnings per share of $1.41, missing the Wall Street estimate of $1.43 by 1.1%, a miss that raises questions about near-term guidance. Coherent is trading below its 20-day average, currently at 355. Management's headline this quarter: exceptional demand and visibility. Three words that appear in every prepared statement, designed to make investors feel the AI-driven optical boom is inevitable. What it's designed to make them not think about: the 10,240 shares insiders net sold in the past 90 days, exactly when LTAs, long-term agreements, multi-year supply contracts with upfront customer cash, were supposedly locking in the future. Here's the decode. Insiders don't sell when they believe their own hype. The magnitude, over 10K shares, isn't noise. It's a pattern that historically precedes margin compression or a demand cliff. And while management touts upfront investment from customers as skin in the game, the real skin is theirs. They're the ones exiting. LTAs with minimal demand commitments aren't guarantees, they're options. If AI capex slows, those customers walk, and Coherent eats the stranded capacity. That's not visibility, that's leverage. The EPS miss, 1.1% light, isn't the story. The trend is 0 beats in 4 quarters, despite R&D surging 21.5% YOY to $582 million, 10% of revenue. That's not efficiency, that's desperation. When a hardware company ramps R&D this aggressively while insiders sell, it signals one thing: the product pipeline isn't keeping up with the narrative. Management calls scale across a very strong growth driver, but the Q&A reveals the truth. Multi-rail revenue won't start until first half 2027. That's a 12-month gap between PR and product. The momentum breakdown for Coherent. RSI sits at 50, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Coherent dominates the hardware layer with 1.6 terabit optical components. This hardware cycle feeds NVIDIA's Blackwell architecture directly. Hyperscalers cannot build artificial intelligence data centers without these physical optical highway ramps. But here's what breaks the bull thesis. Lumentum is aggressively discounting prices to steal market share, threatening Coherent's margins. Additionally, strict U.S. export controls completely lock Coherent out of Chinese data centers. If cloud providers pause capital spending, Coherent's trailing P/E of 170.3x will collapse. P/E is too high to absorb a demand shock. Here is the question Wall Street is too afraid to ask. Can Coherent shift manufacturing out of Asia fast enough to avoid tariffs without destroying margins? The lab's answer is no, not without a major short-term hit. Moving precise optical fabrication lines requires massive capital expenditure. This capital outlay will compress margins while Lumentum actively undercuts them on price. If Coherent successfully ships its 1.6 terabit components for Blackwell within 6 months, the stock will challenge resistance at $426.89. If cloud spending pauses or tariff disruptions hit first, expect a swift drop to support at $353.63. Our AI score of 53 to 100 reflects low conviction in the bull case. We expect a breakdown to support at $353.63 as margin pressure takes its toll. Wolf's momentum stalls. COHR's fundamentals stay steady. Caution on Wolf. Hold core. Not financial advice. Do your own research.